What's up everyone, welcome to Stockton. It's a pleasure to meet all of you. On this channel, we talk about stocks before they start blowing up, say goodbye to chasing stocks at all-time highs, and say hello to making some money. So if this sounds like something you want to take advantage of, then hit that beautiful subscribe button and like the video. Now let's get to it. Before we get into the video, I have to say that I'm not a financial advisor. Anything I say is just my opinion and is for entertainment purposes only. Having said that, if I'm talking about a company, I'll let you know whether I'm personally going to invest in it or not towards the end of the video. But you should always do your own due diligence, so with that out of the way, let's get started.
Hi guys, I just wanted to make a general stock market update today. The Federal Reserve has just signaled that it expects to increase interest rates ahead of schedule. This might affect the stock market in a negative way, and at the time of this recording the stocks are in the red, but it remains to be seen how the overall market reacts to this news over the next few days. Just before this announcement, the Treasury yield rose to 1.56% from 1.49%. The Fed are projecting that interest rates will increase to 0.6% from 0% by the end of 2023. This might be seen as negative news by the stock market because it's happening slightly sooner than what the Fed had originally anticipated. However, it's not all bad news because the Federal Reserve aren't changing their policies just yet. They will continue to buy $120 billion a month in bonds. This is good because the more money the central bank throws into the bond market, the higher the price will be, which will result in lower bond yields. Us apes want to see lower bond yields because when the yield goes down, the stock market goes up. But it will be interesting to see what happens to the bond yield and whether it can remain low because of increasing interest rates. This is what the 10-year Treasury looks like. You see this curve going upwards. Well, this is a direct consequence of everybody getting scared about inflation. But you see we had cooled off over here and the inflation fears had subsided somewhat. But we can see a bit of a spike here today after the Fed's announcement. As things stand, 7 officials now expect to lift interest rates next year. This is up from 4 officials in March. What is interesting as well is that all but 5 members think interest rates will need to increase in 2023. The stock market was expecting no change in rates until at least 2024. Another interesting takeaway here is that 5 officials now see rates at being 1% or even higher by 2023. This means that rates are set to raise sooner and faster than previously thought by the Federal Reserve. So the forecast now is that there will be 2 interest hikes in 2023. During the press conference, Jerome Powell indicated for the first time ever that inflation might turn out to be higher and more persistent than the Fed had originally forecasted. Now, it's not all doom and gloom because Jerome Powell made it a point to hit plenty of dovish notes. Now, dovish, by the way, is a term used when the Fed isn't freaking out about long-term inflation, so that's a positive sign that he was still upbeat. So let's see how the market reacts tomorrow and this week. Let's hope we don't see another massive dump in the stock market. Anyways guys, that's it for today's video. Have a great day or night wherever you are, and I'll see you in the next one.